Quick question, and I want you to think honestly about this. How much of your savings is sitting in a fixed deposit right now? 50,000, 2 lakh, 10 lakh? Now, here's what I want to consider. That FD is probably giving you 6.5 to 7%. It's locked. If you break it early, you pay a penalty, and every rupee of interest taxed at full income slab rate. What if I told you there's an investment that gives you similar or better returns with no lock in, no penalty, no surrender charge, and you can buy and sell it on your phone in 5 seconds? What if it also invested in government bonds, some of the safest assets in the world? It exists. It's called a bond ETF, or more broadly, a debt ETF. And today I am giving you the most complete, most honest guide to bond ETFs and debt ETFs in India, designed specifically for beginners. What is it? How does it work? Which ones to buy? How much? What's the risk? What's the tax? How to invest? Everything. Let's go. So, first, we have the most Indian investors divide their portfolio in two broad buckets. Bucket 1, risky, stocks, mutual funds, crypto for growth, and bucket 2 being safe, fixed deposits, saving accounts, PPF, and for stability. So the problem, the safe bucket is often inefficient. FD, good returns, but money is completely locked. Break it, pay a penalty. Savings account barely beats inflation at 3 to 4%. And PPF, excellent, but 15-year lock-in and rupees 1.5 lakh annual limit. What most investors are missing is a third option, something that sits between the stability of an FD and flexibility of a stock, the safety of government bonds, and liquidity of a mutual fund. That third option is a debt ETF, specifically bond ETF. What is a bond? A bond is simply a loan uh, that can give you like uh, um, loan that give to a government or a company. So they borrow money from you, they pay you interest regularly, they return your principal at maturity. So government of India borrows money this way, called government securities, that is GSECs. And companies also issues bonds called corporate bonds or debentures. So what is a bond ETF? So we have bond ETFs, which a bond ETF is a basket of bonds packaged as a fund, and we have it as many, like it listed and traded on a stock exchange. So just like a Nifty 50 ETF holds 50 stocks, a bond ETF holds multiple bonds. So you buy units of this ETF on NSE or BSE and you get exposure to those bonds. Benefits immediately, like instant diversification, professional management, full liquidity, exchange traded, extremely transparent. And India has seen a massive explosion of debt ETFs in last 5 years, led by the hugely populated Bharat Bond ETF series by Edel, Edel, Edelweiss. So today you can invest in Government of India bonds, corporate bonds, PSU bonds, short-term liquid instruments, all through low-cost ETFs available on your trading app. So this is the investment category most real investors are sleeping on. Not anymore. So these are few of the key bond terms you need to know. Then we have bonds. So the foundation. So if you see, before we understand bond ETFs, we need to understand bond themselves. The So think of a bond as a legally structured IOU. So example, Government of India needs 10,000 crore to fund infrastructure. So instead of going to one big bank, they issue bonds to public. Each bond equal to 1,000 face value, and interest rate of coupon is equal to 7.5% and duration is equal to 10 years. So if you buy one bond, you lend 1,000 to the Government of India. Every year you receive rupees 75 as interest and 7.5% of rupees 1,000. After 10 years, you get your rupees 1,000 back. So the government guarantees both the interest and principal repayment. So this makes government bonds among the safest assets on the planet. Key bond terminology. So if you see the terminology, face value. What is a face value? The original loan amount. That is typically 1,000 in India. And coupon rate is the annual interest rate the bond pays. Example, 7.5%. Um, Coming to maturity date, it is the date when the borrower returns the principal. And yield to maturity, YTM, is nothing but the effective annual return if you hold the bond till maturity. Next, we have credit rating, that is the safety score of the bond. That is AAA is safest. So going down to D, that is default risk. Next, we have bond price versus interest rate relationship. So if you see this, it is very critical. So this is the most important concept in fixed income. So when interest rates rise, bond prices fall. So when interest rates fall, the bond prices rise. Why? It is because the existing bonds with fixed coupons become more or less attractive versus new bonds in the market. So this is called interest rate risk, and it's the primary risk of bond ETFs that is explained in detail later. Now let us see what is a bond ETF and how does it work. So a bond ETF takes multiple bonds, bundles them together and lists the bundle as a single tradable unit on stock exchange. How it works, if you want to see it step by step, then you need to see the step one will be fund house like Ed Lewis, Nippon, SBI. So they select a basket of bonds like government bonds, PSU bonds, or corporate bonds. Step 2 is that this basket is structured as an exchange traded fund, that is ETF. Next, step 3 is the ETF is listed on NSE or BSE, that is, you can buy one unit exactly like buying a stock. Next, step 4 is the ETF holds the underlying bonds. That is, it collects interest payments and reflects this in the NAV, that is net asset value of the ETF. Next, we have step 5, that is bond ETFs price increase over time as interest accrues. So, or you receive it as dividend in some structures. Okay. Next, step 6, we have you can sell your ETF units anytime during market hours, instantly and at a current market price. So, what makes a bond ETF different from a regular debt mutual fund? So, say suppose we are taking trading, the bond ETF will be exchanged, that is real time, and debt mutual fund will be NAV at end of day only. Okay, and minimum investment for a bond ETF is one unit will be 100,000 rupees. For debt mutual fund it will be 500 typically. And expense ratio for bond ETF will be very low, 0.05 to 0.3%, whereas debt mutual fund will be 0.3 to 1% typically. Transparency, bond ETF is portfolio daily, and debt mutual fund is monthly disclosure. Whereas flexibility, bond ETF can sell any second, and debt mutual fund is the redemption plus 1 to 2 days. SIP option, bond ETF is manual only, and debt mutual fund the automatic SIP is available. Okay, so bond ETFs win on cost, transparency, and liquidity. Debt mutual funds win on SIP convenience. Next, let us see types. Okay, types of bond or debt ETFs in India. So India now has a rich variety of bond ETFs. So let me explain each category. Type 1 being Bharat Bond ETF, that is most popular and must know. It is launched by Edelweiss AMC in collaboration with the Government of India. It invests exclusively in AAA rated PSU bonds, highest quality corporate bonds, and a target maturity structure. So you know exactly when the ETF matures and multiple series like April 2023, it was matured. April 25, 2025 matured, and April 2030, 2031, and 2032. So why Bharat Bond ETF is special is that because Government of India backed indirectly because it's PSU bonds, and fixed maturity date because you know exactly what return to expect if you hold till maturity. Next, we have YTM, that is current yield to maturity. So, on longer series, approximately 7.4 to 7.8% per year. Then we have expense ratio of just 0.0005%, almost completely free to run. And 10 lakh plus retail investors have already invested. That is extremely popular. So this is the single most popular bond ETF in India. So if you remember nothing else from this video, remember Bharat Bond ETF. Okay. Next we have a type 2, that is GILT or Gilt ETFs. So these are government security ETFs. So these ETFs invest purely in Government of India securities, the safest bonds in the world, no credit risk whatsoever. And the Government of India cannot default on its own currency bonds. Example, Nippon India ETF, Nifty CPSE bond plus SDL, and SBI Nifty 10-year benchmark, and GILT ETF, ICIC Pru Nifty 10-year benchmark, GSEC ETF. So best for investors who want absolute capital safety with better returns than saving accounts. Current YTM and approximately 7 to 7.5% for 10-year Gilt ETFs. Risk, high interest rate sensitivity, and prices fall when RBI raises rates. So, in a rate cutting environment like now in 2026, gilts perform very well, that is, GILTs perform very well. Next, we have type 3, which are liquid ETFs. So, these ETFs invest in very short term money market instruments like overnight securities, treasury bills, etc. So, extremely safe, very low volatility, especially a liquid parking space for cash. Examples like Nippon India ETF, Liquid BEES, ICICI Prudent Fund Liquid ETF. So why liquid ETF instead of savings account? Because liquid ETF returns 6 to 7% per year versus 3 to 4% in savings account. And full liquidity, like sell in seconds, excellent for parking emergency fund or money you will need in 0 to 3 months. And consider liquid ETF as a high yielding yield savings account alternative. Next we have type 4, that is corporate bond ETFs. So invest in bonds of large private or public companies, like AAA or AA rated, like AAA or AA rated, because higher yield than GILT ETFs, because corporate bonds carry slightly more risk than government bonds. So examples, Nippon India ETF Nifty, corporate bond, and Edelweiss Nifty corporate bond ETF. So current YTM, that is yearly YTM, like, so approximately it's 7.5 to 8.5% higher than comparable gilts. Okay, so that is GILTs. Next, we have fifth type, that is PSU bond or ETF. So Here we invest in bonds of government owned companies like here we invest in government owned companies like NHAI, REC, PFC, NTPC, etc. So quasi government safety, that is very low credit risk. So higher yield than pure government gilts. So because there's marginally more credit risk. Example, Nippon India ETF PSU bonds, SBI ETF Nifty PSU bond, and current YTM will be 7.3 to 8.8% approximately. Next, we have another type, that is target maturity ETFs. That is Bharat bond is one example. Like ETFs with a fixed maturity rate, like a bond but in ETF form. So you know the maturity date, the approximate YTM at investment. So like you hold till maturity, then you receive approximately the started YTM. Then if you do like exit early, you get current market price, which could be higher or lower depending on rate environment. Best of both worlds, bond like returns with ETF liquidity. Okay, next we have best bond ETFs in India 2026, like detailed profiles. First we have, like, let's now go through the most important and popular bond ETFs in India. First being the Bharat bond ETF. Okay, so it is April 2030 to April 2031 or April 2032. Issuer is Edelweiss AMC, that is Government of India initiative. So what it holds is top AAA rated PSU bonds, NHAI, REC, PFC, NTPC, NABARD, and Power Finance Corp. And target maturity will be April 2030 or 2031 or 2032, different series. And current YTM is 2026. So approximately 7.4 to 7.8% per year. And expense ratio being 0.0005%, essentially zero cost. And the lowest expense ETF in India. Minimum investment is 1 unit, approximately 1,100 to 1,300 per unit. And key features being fixed target maturity. So hold till 2030 or 31 or 32 and earn the stated YTM. If interest rate falls, rate cutting cycle, price also appreciates, like double benefits. And Government of India PSU bonds is like near zero credit risk and listed on NSE and BSE, completely liquid. Next, scenario analysis, if we see, it is like 1 lakh invested in Bharat bond 2032 at 7.6% YTM. If held till 2032, like 6 years, then like approximately 1,55,780 maturity value. If rates fall 0.5%, it gives capital gain on top of this. So best for conservative investors who want better than FD returns with PSU level safety and a clear endpoint. So the most recommended bond ETF for beginners in India, and risk level is very low. Next we have um, Nippon India ETF Nifty 10-year benchmark G-Sec issuer. Okay, so this is the Nippon India AMC, that is a Gilt ETF, that is GILT ETF. Okay, so what it holds is Nifty 10-year benchmark G-Sec index, which is Government of India 10-year bonds, and current YTM being 7 to 7.5%, expense ratio being 0.1 to 0.15%, and interest rate sensitivity being high, like 10-year gilts are, that is GILTs are sensitive to rate changes, and in the current rate cutting environment, this ETF benefits from capital appreciation, and it's best for investors who want zero credit risk plus are betting on future RBI rate cuts, which push gilt prices up. And rate cut environment is very good for this ETF. Risk level is low, the like credit risk, and medium for interest rate risk. Next, we have third one, that is Nippon India Liquid BEES, and issuer being Nippon India AMC, and it is a liquid ETF. What it holds is overnight and short-term money market instruments, and it returns approximately 6 to 7% annualized, which can be variable with short-term rates. And a unique feature is that it distributes income daily as additional units or fractional units, and price stays stable at approximately 1000 per unit while you accumulate fractional units. So minimum investment is 1 unit is equal to 1000 approximately. So best for parking emergency fund, like 3 to 6 months of expenses, holding idle cash between investments, and better return than savings account from same day liquidity, and margin for F&O traders, so can be used as collateral on NSE. Coming to risk level, it is extremely low, practically no risk to principal. Next, we have Edelweiss Nifty PSU bond plus SDL April 2026 60 to 40 index fund, and the issuer is Edelweiss AMC, and it is PSU plus state dev loan ETF. So what it holds is 60% of PSU bonds plus 40% state development loans, that is SDLs, and current YTM being 7.5 to 8%, one of the higher yielding government backed debt ETFs. SDL explained is that the state government also issues bonds, that is SDLs, to fund their spending. So the RBI guarantees repayment, and then the slightly higher yield than central government gilts. So it is best for investors wanting a higher yield from government guaranteed instruments, the central PSU plus state government bonds combined. The risk level will be low. Coming to next one, that is ICICI Pru Nifty AAA corporate bond, that is ETF issuer being ICICI Prudent AMC, and it's a corporate bond ETF. It holds Nifty AAA corporate bond index, top rated corporate bonds from private companies, and current YTM being 7.8 to 8.5%, higher yield than PSU or Gilt ETFs, and credit rating being AAA only, the safest corporate bonds, and it's best for investors who want slightly higher yield than PSU bonds and are comfortable with private sector corporate credit. It's a AAA rated and very safe historically. Next, we have risk level. The risk level will be low to moderate, marginally higher than government or PSU bonds. Next, we have master comparison again. So the ETF being Bharat bond, if for Bharat bond, it is its target maturity type, and it has YTM up to 7.4 to 7.8%. It very high safety, high liquidity, and it's best for FD alternative. Next, we have Nifty 10-year GSEC ETF, which is type is Gilt, and YTM being 7 to 7.5%, high safety and high liquidity, and rate cut rate cut play is like it's best for rate cut play. And next we have liquid BES, which is type is liquid, and YTM being 6 to 7%, safety highest safety, and has instant liquidity, and it has cash parking, it's best for cash parking. Okay, next we have PSU bond ETF, that is type being PSU, YTM is like 7.5 to 8%, very safety is very high, liquidity is high, and it's best for higher safe yield. Next, we have AAA corporate ETF, that is corporate type being corporate, YTM being 7.8 to 8%, 8.5%, and safety being very high, liquidity being high, and it's best for max yield safe. Next, we have How much do you need to invest? So for Bharat bond ETFs, approximately 1100 to 1.3k. Okay. Next, Nifty Gilt ETF is 100 to 200 rupees. Next, liquid BEs is 1k. PSU bond ETF is 100 to 200. Corporate bond ETF is 100 to 300. These are the minimums. So minimum like 1 unit. So you can start from as little as rupees 100. For meaningful returns, start with 10,000 to 50,000. That like makes the income noticeable. And you can build positions gradually. Add units every month like a manual SIP. Next, let us see the returns, which is realistic expectations. So let's talk real numbers now. So bond ETF chart returns. So if you see savings account will give 3 to 4% return. Short term FD for 1 year will give 6.5 to 7%. Liquid ETF will give 6 to 7%. Bharat bond ETF will give 7.4 to 7.8%. PS bond ETF will give 7.5 to 8%. And corporate bond ETF will give 7.8 to 8.5%. And long gilt ETF will give 7 to 7.5% plus rate cut upside. So in rate cutting environment like India 2025 to 26, gilt and long duration bond ETFs can deliver 10 to 14% total returns in a single year because falling rates push bond prices up significantly. This is above and beyond the yield and its capital appreciation on top. So rupees 1000 calculation example, Bharat bond 2032, like 7.6% YTM. If we see year one, if we have like invested 1,07,600, it will become for next year it will become 1,15,776. Next year it will become 1,24,576, and next year it will become 1,44,249, and for sixth year at the maturity it will become 1,55,276. So safe, predictable, better than FD, and no lock-in. Next, let us see the advantages. Okay, advantages of being in this bond ETFs. So first one is better return than savings. So account and near FD returns like 6 to 8.5% YTM versus 3 to 4% savings account. Like the competitive with and sometimes above FD rates. Second being the complete liquidity. So no lock-in unlike FD. Sell your bond ETF units anytime during market hours. No penalty, no surrender change. This is the single biggest advantage over FDs. Third one being government backed safety. So for Gilt and PSU ETFs. So Government of India bonds cannot default in Indian rupee terms. So like PSU bonds from NHAI, REC, PFC are quasi government, virtually zero credit risk. Fourth being extremely low cost Bharat, extremely low cost because Bharat bond ETF expense ratio is 0.0005% and nearly free compared to debt mutual funds, that is 0.3 to 1%. Massive cost saving over time. Uh, Fifth being tax efficiency versus FD because bond ETF gains taxed as capital gains, not income from other sources like FD. And LTCG at 12.5% if held 3 plus years per pre April 2023 rules. See the tax sections for update. And FD interest taxed at full slab rate up to 30%. Bond ETF can be significantly more tax efficient. And sixth being transparency portfolio. So you know exactly which bonds the ETF holds and you can publish daily. So unlike debt mutual funds, no hidden credit risk. And seventh being the rate cut windfall. So in a rate cutting cycle, Long duration gilt ETFs deliver capital appreciation on top of yield. So FD holders miss this entirely and they are locking in at old rates. Eighth being multiple options for different needs. Liquid ETF that is 0 to 3 months and short duration like 1 to 3 years and target maturity is 3 to 7 years and gilt is long term. So match your investment horizon to right ETF and it's very customizable. Next, let us see some disadvantages or let us see some risks. Okay, so first one being interest rate risk. This is most important. Like when RBI raises interest rates, bond prices fall. Your bond ETF NAV decreases. Long duration ETFs, 10 plus year gilts are most sensitive to this. So short duration ETFs, liquid 1 to 3 year are minimally affected in a rate hiking cycle like 2022 to 23. Long gilt ETFs gave negative returns for a period. Next, second, we have returns not guaranteed, like unlike FD. So FD gives you a fixed contractual return, like bond ETF return depends on market prices. So if you sell before maturity, you might get more or less than expected. So if you hold Bharat bond ETF till its target maturity, you get approximately the stated YTM. So if you sell early, the market price determines your actual return. Okay, so third being the tax rule changed in April 2023. Important, like from April 1st, 2023, debt mutual funds and debt ETFs lost their indexation benefit. Like previously, LTCG on debt funds after 3 years was taxed with indexation, like very efficient. Now gains are added to income and taxed at your slab rate, just like FD interest. So exception being bond ETFs list on exchanges like Bharat Bond ETF, and these are treated as equity type ETFs and still let LTCG as 12.5% after 12 months, so not 36 months like debt MF. And this makes listed bond ETFs more tax efficient than debt mutual funds post April 2023. Fourth being credit risk. So for corporate bond ETFs, while AAA corporate bonds are very safe, AAA rating can be downgraded. Historical examples like IL and FS, DHL fell were high rated before defaulting. Like pure government or PSU ETFs have no such risk. Fifth being lower returns than equity bond. So ETFs deliver 7 to 9% over the long term. Equity delivers 12 to 18% over the long term, and bond ETFs are not equity replacements. They are fixed income instruments with a specific role in your portfolio. Next, we have sixth limitation, that is tracking error. So ETF specific issue. So sometimes the ETF's market price deviates from its actual NAV, that is actual tracking error. So most small for liquid, large bond ETFs, it will be but worth monitoring. So check the premium or discount to NAV before buying and prefer to buy when ETF is at uh, or below NAV. Okay. Next, let us see the tax. So the tax treatment of bond ETFs changed significantly in April 2023. Let me explain clearly. So in 2023, the change, what happened was before April 1st, 2023, the debt mutual funds held 3 plus years, that is LTCG with indexation, and it was very tax efficient. After April 1st, 2023, the debt mutual funds, all holding periods have had gains taxed at income slab rate and indexation gone, and tax efficiency is equal to eliminated completely. Then how are exchange listed bonds ETFs taxed? So for this, listed bond ETFs, Bharat Bond ETF, Nifty, Gilt ETF, Liquid, BES, etc., are treated efficiently because they are listed equity type ETFs. So, under 12 months, the tax will be STCG at 20%. Over 12 months, it will be LTCG at 12.5%. So, this is a massive advantage over both FDs and debt mutual funds post April 2023. Like if you see the comparison for FD, okay, FD, the tax will be at slab rate up to 30% and effective tax, that is 30% bracket, like 3 years will be 30%. And debt mutual fund tax will be like slab rate all periods now, and tax for 3 years will be 30%. Bond ETF, it will be LTCG 12.5% after 12 months, and effective tax bracket will be like 12.5%. So if 30% tax bracket, bond ETF is significantly more tax efficient than FD or debt MF. So so in the 0 to 10% bracket, difference is smaller, but bond ETF still wins on liquidity. So TDS being like bond ETFs don't have TDS on capital gains. So you declare and pay in your ITR. If ETF pays dividend or income distribution, then TDS at 10%. So ITR filing when you're doing, see that capital gains from bond ETFs are scheduled CG in ITR 2. Okay. Now let us see how to how to invest in bond ETFs. So buying a bond ETF is exactly like buying a stock or any equity ETF. Step 1, open a demat account like Zerodha, Groww, Upstocks, Angel One, ICICI Direct. And if you already invest in equity, you can invest in bond ETFs with the same demat account. Step 2 being search for the ETF on Zerodha or Groww. Search Bharat Bond or Liquid Bs or CPSE or PSU Bond, and the ETF appears exactly like a stock. Step 3 being check the YTM and NAV before buying. So check the current YTM, expense ratio, tracking order, or and premium or discount to NAV, and all available on the AMC website or multi control. Okay. Next, for the step 4, you place buy order and the market order, and buy at current price or limit order. So set your price. Like minimum, keep it as 1 unit. Okay. Next, step 5, hold or sell for target maturity ETFs. So Bharat bond. So hold till the maturity for best result. So for liquid ETFs, sell whenever you need cash, same day or next day. For Gilt ETF, hold in that rate cutting cycles and sell when the rate start rising. Okay. So smart investment approach here will be emergency fund. So liquid BES like 3 to 6 months expenses. Then short term goal like 1 to 2 years. Then PSU bond ETF or short Gilt ETF, and medium term like 3 to 7 years, and Bharat bond target like maturity ETF. So rate cut play, and Nifty 10-year Gilt ETF. So no SIP directly, but you can like set a calendar reminder every month and manually buy n units, and this mimics a SIP perfectly. So now we have a comparison from bond ETF versus other instruments. So we have return. If you take a factor as return, bond ETF has 7.4 to 8.5, FD 6.5 to 7, liquid ETF 6 to 7, PPF 7.1 to 7.1, and savings 3 to 4%. And coming to liquidity, bond ETF have exchange instant, FD don't have penalty, and like don't have and liquidity, and it has penalty. Liquid ETF has, and it will get at same day. PPF also don't have because it has 15-year lock. And savings have, savings yes, because it is instant. Next we have guarantee. Like we don't have any guarantee for bond ETF because it is market linked. For FD and liquid and PPF and savings, everything we have guarantee. Tax, everything we have tax except FD. FD will be at slab rate, and savings account also will be at slab rate. And we have credit risk, very low for bonds. FD it is very low, and for liquid PPF and savings it is nothing. Risk is not there only. Cost it will be 0.0005 to 0.3% for a bond, and for FD it will be 0. Liquid it will be 0.05 to 0.1. PPF it will be 0. Savings also 0. Capital growth is only for bond ETF we have capital growth, and others all are fixed or stable or fixed. And inflation on hedge, partial for bond ETF and partial for PPF. So verdict is like most investors like bond ETF outperforms FD on tax efficiency and liquidity, and PPF is still king of the tax free like 7.1% return, but 1.5 lakh limit and 15-year lock. So liquid ETF is greater than savings account for any cash holding beyond immediate needs. Okay. Next we have current affairs connection. So why now? So why is 2026 an excellent time for bond ETF investment? Is that first one being RBI rate cutting cycle. Biggest catalyst that RBI has been cutting interest rates in 2025 to 26, and when rates fall bond prices rise, and bond ETF investors profit from both yield and capital appreciation. So long gilt and ETF can deliver 12 to 15% total return in aggressive rate cut scenarios. And this is the single most powerful reason to add bond ETFs right now. Second being that FD rates coming down. So as RBI cuts rates, bank reduce FD rates too. And new FDs now offer less than before. And existing bond ETF investors benefit as their ETF prices rise. And those still locking money in FDs at new lower rates miss the capital appreciation completely. Third, we have Bharat Bond ETF new series expected. So Edelweiss has been adding new Bharat Bond series regularly, and each new series allows fresh investment at current yield and provides new target maturity options. Fourth being institutional demand for government securities. So insurance companies, provident funds, pension funds all required to hold a significant portion in government bonds, and this structural demand keeps gilt yields supported and prices stable. Fifth being India's fiscal discipline. So government of India maintaining fiscal deficit under 4.5% of GDP. Better fiscal discipline means better credit quality of government bonds and lower risk of gilt ETF investors. And sixth being global bond market tailwinds. So US Fed rate cuts plus global easing gives capital flowing into emerging market bonds like India, and foreign institutional investor demanding for Indian government bonds rising and supporting prices. So coming to final summary, let's lock in most important takeaways. That is, what is bond ETF? So it's a basket of bonds, government, PCU or corporate, and packed packaged as an ETF and listed on NSE or BSE. Types are Bharat bond, which is target maturity, and PSU bonds, Gilt ETF, liquid ETF, corporate bond ETF, PSU bond ETF. Next, we have returns to like 6 to 8.5% YTM plus potential capital gains in rate cut environments. Best ETFs 2026 is Bharat Bond 2032, like it's beginners FD alternative. And it in liquid BES is cash parking, Nifty Gilt ETF is rate cut plea. Tax advantages is that it listed bond ETF pays only 12.5% LTCG and 12 months. And it's much better than FD like slab rate and debt MF. And slab rate post April 2023. Coming to risk, very low credit risk because especially government or PSU ETF. And coming to interest rate risk, it exists for long duration ETFs, so reduces in a rate cutting cycle. Coming to how to invest, same demat account, Zerodha or Groww, search ticker, buy one unit, no SIP directly, manual monthly purchase works. Coming to why now means it's a rate cutting cycles that means it's a bond price appreciation plus falling FD rates is equal to bond ETF is the smartest fixed income move in 2026. And if you have been putting money in FDs and savings accounts without knowing about bond ETFs, I hope this video was genuinely eye opening. So you don't have to choose between safety and returns. Bharat Bond ETF gives you PSU safety plus FD comparable returns plus stock exchange liquidity plus better tax efficiency. So hit like if this video helped you think about fixed income differently. Drop a comment. I'm switching from FD to bond ETF, or ask me any specific question. Please do like, share, and subscribe, and bell icon like because every week I publish guides like this one, honest, detailed, beginner friendly finance education. Share this with anyone who has significant or savings sitting in an FD and they need to know this exists. Take care and see you next.